Hey there guys, welcome to this video. My name is Pushpinder Gill and we are still in the Principles of Marketing course. And in this video series, we've been talking about marketing plan. And this is one of the videos on marketing plan. So we in other videos, I did talk about your mission and mission objectives. I did talk about SWOT analysis. We did talk about segmentation, targeting, and positioning. So we're still in the implementation phase, and there are other two tools that I want to talk about, which is with regards to your marketing strategy. So the first tool that I want to talk about is called a Boston Consulting Group Matrix, or also called a BCG Matrix. Now, this is a very handy tool in trying to figure out your marketing strategy with regards to different products that you have. So a firm such as Coca-Cola has multiple products. Apple has multiple products. As you can see in this image, it's got an Apple Watch, it's got some iPhone, it's got iPod, it's got iPad. So it's got so many different markets, so many different products which compete in different markets. And this tool will actually help you figure out what should be the strategy for your products. So what you can do is you can actually develop a 2x2 matrix wherein you talk about, on one dimension, you talk about what is the market growth rate for that particular product. So how fast is the market growing for that product? And the next one is, what is your relative share in that particular market? So what is your share among your competitors in that market? So for instance, if you look at Apple Watch, the Apple Watch, the market for wearable technology is growing. It's growing fast. So the market growth rate for something like Apple Watch is really high. And if you actually look at the market share of Apple in the watch industry, in this kind of watch industry, which would be the digital watch industry, their market share is relatively high in that particular market. So which means these products will actually be classified as stars. These are the products which are the future of that particular company, because they are in a market with high market growth and they have a high relative market share in that particular market. So what should be your strategy for these products? Your strategy should be to invest in these product lines and to improve these product lines by as much as possible, because they are an opportunity to accumulate growth. They are an opportunity to accumulate revenue, and these are the products will actually take you way into the future. The next one are the products which has a high market growth, but you have relatively low market share in that particular area. So that means the market is growing fast, but you do not have a high market share in that particular market. Well, iPhone is an example. I think, you can say that iPhone doesn't really have that much of a market share when it comes to the phone industry. The other Android products have high market share, but it's a growing market. Phones are a growing market. So all these products will actually be your question marks, which means that do you really want to be in that particular market category, because you're not really going. Your product is not really working out well in that particular market. So you should really be focusing on a lot of research and development in this particular product category, trying to improve the product, trying to find what is it about this product, how can I gain more market share. If that's not the case, then you should really be putting a question mark on the product. You should really be trying to find out the feasibility of going for this product category. Then the next one is really the product categories where you have high relative market share, but this market is not growing by a lot. So the market is not growing, but you have a lot of market share in that product category, and that is actually going to be your cash cow, which means you don't have to do a lot in this product category. What you have to do is you just have to maintain your market share. You just have to sell this product as it is, because they are your cash cows, and these are the products which are actually giving you revenue right now. So these are your cash cows, and my strategy would actually not be trying to improve these products, because the market is not really growing that fast. It would be just to appropriate as much value as you can. The next type of products, which are the worst type of products for your company, are the ones which have the lowest market growth and the lowest market share, which are classified as dogs here. So the Apple's iPod would actually be classified into this category because the iPod market has been completely ruined by the new phones. So there's not really a lot of market growth happening there, and iPod and Apple doesn't really have too much of a market share left in this product category. So those would be classified as dogs. So these are kind of the product categories that you should try to remove. These are the product categories where you should not be investing a lot. So that is what a BCG Matrix is. It's a great tool to help you to organize your products and then devise different strategies for your products. Then another tool that I want to talk about in this video is actually called a growth matrix. It actually talks about what kind of strategy, what kind of growth strategy you should be incorporating for some products. So for instance, you are Apple and you are trying to think about the current products that you have, or you're going to think about new products that you want to develop. So you can either grow in your current product line. So that you can do that by aggressively marketing the product, trying to go for as many customers as possible. So an example that comes to my mind is when Apple launched the iPhone SE, which was a cheap version of an iPhone. So that was actually a strategy by Apple to really get into the phone market, to really even start catering to low-end phones. Or what you can do is you can start a new product altogether, or you can enter a new market altogether. So this matrix, or this 2x2 matrix, kind of helps you to identify the strategies that you should be incorporating. So the first one is basically it's whether you are entering a new market or you are in the current market, and this one is whether you are in the current product line or you're adding a new product line. So the first one is very easy, is that if you actually want to grow in the current market with the current product line, so for instance, if Apple wants to sell more iPhones, then it should actually be going for market penetration strategy. So as the name suggests, it is penetrating into that market further, which you can do by offering discounts, by offering promotions, by doing a lot of advertising. So you are essentially just trying to break into the market for which the product is intended. So iPhone is intended to be a phone, and let's suppose Apple wants to sell more iPhones in the United States. So it would actually take market penetration strategy. On the other hand, you can have the same product line, which would means you can keep the same product. So that would be iPhone, but you want to enter new markets. So let's suppose Apple wants to sell iPhones in India, which would it's not the case right now, but at a time it was a new market for Apple. So then you will actually be going into market development strategy, where you will actually trying to develop the market according to your products. So in that case, you would actually give a lot of free trials. You actually, you would actually motivate consumers to try out their product, because you're actually trying to develop the market. Promotions do really help there, but more of trying out the innovators, the innovative customers should be trying out your product. Similarly, Coca-Cola has penetrated itself into a lot of markets. So when Coca-Cola goes to a new country, it should give out a lot of free samples to its customers. It should have these partnerships with other firms where it actually gives away its product, so that it's actually developing the market. Another way a company can grow is by developing a new product line for the same market. So Apple really did that with its iPad. So it launched its iPad, and it was a different product than an iPhone, and it is called product development. So you develop a new product for the same market. So you understand the market, that's good. But you're trying to cater to their different needs. And there's going to be a lot of cannibalization with your existing product line if the products are related. However, sometimes firms take this decision to generate overall growth rather than just simply, at the cost of cannibalizing their own sales. So they launched the iPad, which was a new product, but they're trying to sell it to the same US market. Or what you can do is you can develop a new product for a new market, which would mean you are diversifying. So you're actually developing a new product for a new market. You're going for diversification. That's going completely new. So this is a strategy. This is again a growth strategy, which is a very, very risky strategy because you don't understand the product and you don't understand the market. So you don't really understand anything there. So you're actually entering a completely uncharted territory. So companies have to do that because when there are no other growth opportunities left. So initially firms should go for market penetration, which means they should go try to penetrate their market by as much as possible. Then they can go for either market development or product development, depending upon where they feel more confident. Diversification should really be the last choice because that's a very challenging growth strategy to have because you're entering new markets and you are coming to those new markets with different products. An example comes to my mind is McDonald's when it actually entered India and it launched a lot of vegetarian burgers, which was completely new to them, and they are actually entering a new market. So that's diversification. If it works out, it opens up a lot of avenues for you. If it doesn't work out, then it doesn't really work out for you. That doesn't mean that the other strategies wouldn't fail. Market penetration fails sometimes. Product development or market development fails a lot of times. Another example, another failure of market development is Starbucks in Australia or Target in Canada, where it launched the same product but in a new market and it did not really work out. So this would be about this video, guys. Thank you very much for watching this. I hope it was enjoyable. Thank you very much, and I'll see you in the next one.